Hi, this is Sive Morten with the daily update on EuroFX. I post my exclusive market overviews with the key political and economical events, charts and important levels on the ForexPeaceArmy.com forums weekly. This short video is a response to rapidly changing situation on the currency markets and should help you to stay on top of the game and be profitable. I suggest you to visit ForexPeaceArmy.com forum and read my analysis for the week before watching this daily video. Greetings everybody, Merry Christmas. Well guys, as in fact the financial markets on Europe and United States in effect closed, and there were no much changes in yesterday's trading session on the Christmas Eve. Markets were really thin. It's really nothing to talk about on the euro currency since the price action was really tight and market still stands where it was yesterday. That's why today I have decided to just update the situation on the Japanese yen, because here is something is happening, and at my taste this really could be interesting. So let's start from the daily time frame chart. If you remember in our weekly update and previous update on the Japanese yen, we said that the major resistance will stand at the 105.60 area approximately, and if market will respect to this resistance, the potentially market could turn to the to form the double ripple sell on the monthly time frame chart or something of that sort, because on the monthly time frame chart you could find a really nice thrust up. The first spike has happened. This was previous top, and it has marked by this dash line, maroon dash line here. Market has passed through it, and we said that if market will fail to pass through the 105.60 resistance and will return right back down, that could be the double ripple sell on the monthly time frame chart, and that could trigger a significant retracement. And one of the reasons for that retracement is this previous solid and long-term bearish trend on the Japanese yen. Sharply speaking, on the Japanese yen that was the bullish trend, but for the period let's use the JPY that was the bearish development. So that's why the momentum of this move is really significant, and in fact the whole move to the upside that Japanese yen has shown, in fact this is the first move up after the long-term move down. That's why the momentum is still here and will press on the market and could force the market to show the deep retracement. That's why I can't exclude the possibility that Japanese yen in fact could show the significant retracement on the monthly time frame chart, and this retracement could be triggered by the double ripple sell pattern on the monthly time frame chart. That's why the 105.60 area is very significant. At the same time, recall how this situation has developed. We said that market first should hit this 103.80 resistance, the target here as well, and after that it could form the double ripple sell as well to show some retracement respect on this resistance, but that hasn't happened. And when we have seen this gradual move down and market hasn't even closed below the 3x3 to confirm the double ripple sell pattern, we said that something is wrong with this pattern, and it probably will mean that market will continue to move up. And that really has happened on the Federal Reserve announced in the quantitative easing tapering program. Market has jumped up and moved above these previous highs on the weekly time frame chart, on the monthly time frame chart, and now it still stands here. Okay. Also take a look that we have the bearish divergence with the MACD, but the divergence is not always leads to the reversal. The advanced analysis of the divergence by the Judd Naples suggests the divergence could indicate quite vice versa, the bullish sentiment, and it calls as the bullish dynamic pressure. So when the market shows the bearish trend but price continue move higher in the opposite direction to the trend, this tells the bullish dynamic pressure, and usually tells the taking out of the previous highs, and that has happened. So I mean that on the daily time frame chart, the appearing of such development is not just occasional move, and it's just showing that market is not ready to turn to the downside. That suggests that probably market still could continue move right to the resistance around 105.60, 105.70 area. And take a look that after breakout and this move up, market has formed side by side 3-4 stop grabbers. So was stop grabber bullish, stop grabber to the upside, here, here, and here as well, just as well. And what is interesting is that the invalidation point of these stop grabbers stands right at these lows, and these lows coincides with the broken previous top on the weekly time frame chart. It's 103.80 area. Okay, so it means that if market will move below it, it will simultaneously raise the stop grabbers and simultaneously will return right back down below the broken highs. And that the development that we do not want to see very much if we count on some upward continuation. So return right back down will be not very good sign for the further development. But taking broader look at this picture, our invalidation point, I suspect, stands right here, these lows. Because if market will return right back down and take out of these lows, it will form the greatest swing to the downside that was to the upside. Besides, in this case, it will erase this all positive action to the upside that was triggered by the Fed Reserve decision. And that will be the really bearish sign, and that could lead to the starting move to the downside and to appearing of the double repo sell on the monthly time frame chart. So it will mean that market will not start the double repo right from the 105.60 resistance, but it will start it somewhere from this area. Because if you'll take a look at the weekly and monthly time frame chart, you'll see that in an area between the 104.80, 105.60 area, there are some targets stand. So ABCD target, extensions of the retracement, and so on. And take a look. Currently, market take the shape of some sort of the channel, some sort of the rising flag pattern, and if it will show the breakout to the downside, that will be the bearish sign. Why it could happen? If you'll take a look at the 4-hour time frame chart, you'll see that by the shape, market has formed the 3-drive sell pattern. Because take a look that this spike stands at 127 of this retracement, and this spike stands at 127, this red line, of that retracement. Also take a look that here is 1618 of that retracement, of the first drive. So we can see that third drive stands in the combinations of the 1618 and 127 of the corresponding of the first and the second drive. That's very typical for the 3-drive pattern. The one moment that I do not like with this pattern is that acceleration right in the third drive. I prefer to see the signs of this housing when the market forms the 3-drive pattern. Some sort of the wedge pattern, divergence, and it's preferably if the 3-drive will appear at the resistance. But here we do not have any resistance because market already has passed through it. And in general, the price action that has developed here, it just shows that market doesn't wish to show any reversal because it already has the chance to do that. With this spike up hitting the target, it could form the double repo sell, but this hasn't happened. Now market already has passed through this target, and it's not quite logical. It's very difficult to combine the pairing of the 3-drive as that is a reversal pattern, and inability and absence of the wish of the market to form confirm the double repo sell at a much better situation that has happened previously. I suspect that something is wrong with this 3-drive, especially with this solid move up. Also take a look that market holds harmonic swings very well, so you can see that these swings are equal as the distance and as the angle. The same as here. The retracements are very harmonic. Slightly smaller, slightly greater, but in general the market holds them. And following this harmonic development, market still could form some sort of the ABCD retracement down, and that will not be the strategy for the potential move up. That's why I choose the invalidation point right here, because if market will take out of these lows on the daily time frame chart, it will have to exceed the harmonic swing here. It will have to break the harmonic swing to the downside. That's why this will be some sort of the invalidation point. Meantime, take a look. The market is forming some sort of the head and shoulders pattern right here. And if you take a look at the hourly time frame chart, you will see it much better. So we have this head and shoulders. And the target of the head and shoulders, if you take a look at this A, B, C, D down, take a look that this ABCD coincides with the harmonic swing distance on the 4-hour time frame chart, and it stands in agreement with the 103.50 area. That is the 618 support of the whole move to the upside. Okay, so completion of this ABCD pattern and head and shoulders pattern will not lead to the breaking of the bullish tendency on the 4-hour time frame chart. So that will be normal. But if market will exceed it and take out of these lows, will break the harmonic swing, that will be the warning sign for the bullish development. Also, guys, take a look that potentially this head and shoulders could fail and market could turn to the forming of the butterfly pattern to the upside. Take a look at this. This could be the right wing, left wing of the butterfly. If market will fail to continue move lower, it could turn to the forming of the butterfly sail, and that could lead market particularly precisely to our area of resistance on the weekly time frame chart. So currently it's very interesting to watch for what will happen. That's been said that the price action on the daily time frame chart makes me think that we should not rely too much on this free drive, because it has some flaws in the development, particularly this very fast acceleration right to this target, absence of the exhausting signs, and inability market to show the reversal pattern when it logically was to do, with this hitting of the ABCD targets and previous highs, forming the stop grabber. Market hasn't formed double repulse sell. It means that probably market doesn't want to turn to the downside right now, and we should not rely too much on this redrive sell pattern. At the same time, head and shoulders pattern could trigger some retracement, and it will be normal to the 103.40, 103.50 area. It will not break the upward bullish tendency. Our invalidation point here is right here, I suppose. If market will fail to hold at the support and will erase this thrust up, then we could say that probably we should be ready for the downward development. So there are these two signs that we should keep an eye on the Japanese yen by far. And in the longer term, our major target is the watching for possible starting retracement on the monthly time frame chart, because this could be really the gold mine for possibilities for trading the Japanese yen in a long-term period.